What a week it's been for the US dollar. At first glance, the dollar appeared to have every reason to move higher, but softer inflation data told a different story. The week began with the US dollar trading near the 101 level as markets reacted to renewed tensions between the United States and Iran. Rising oil prices and concerns surrounding the Strait of Hormuz supported safe haven demand and increased expectations that the Federal Reserve may need to keep interest rates elevated for longer. Then came Tuesday's inflation report. US CPI surprised to the downside with annual inflation slowing to 3.5% from 4.2%, while core CPI eased to 2.6%. Markets quickly reduced expectations of a near-term rate hike, seeing the dollar lower across the board. Wednesday brought another surprise. Producer inflation also came in softer than expected, reinforcing the view that inflation pressures may be easing. At one point, traders cut the probability of a July rate hike to below 10%, and attention shifted towards September. However, the dollar didn't stay down for long. Strong US retail sales and initial jobless claims later in the week reminded investors that the US economy remains resilient. At the same time, the ongoing conflict in the Middle East kept oil prices elevated, raising concerns that energy-driven inflation could return in the months ahead. Federal Reserve officials, including Chair Kevin Walsh and Vice Chair Philip Jefferson, maintained a cautious tone throughout the week, emphasizing that the fight against inflation is not over and that future decisions will remain data-dependent. As we head into next week, the dollar index continues to hold above the key 100.50 support area. Traders will be watching to see whether softer inflation or geopolitical risk become the dominant theme. Will the dollar continue to consolidate, or is another move higher on the horizon? Let us know in the comments. Do you expect the US dollar index to break back above 101 next week, or are we headed for another test of the 100 level?